$1 trillion. That's how much Chinese money used to flow into American businesses. Think Hollywood studios, Wall Street banks, even tech giants. But now, Beijing just slammed the door shut. No heads up, no negotiation. Overnight, the cash pipeline dried up, leaving U.S. executives stunned and scrambling for answers. This isn't just a random policy tweak. It's a financial gut punch that could signal a new kind of war. One not just about trade or tech, but cold, hard capital. And it's not just boardrooms feeling the heat. This could hit your wallet with layoffs, higher prices, or even a frozen 401k. So, what's going on? Why did China just block all investments in U.S. companies, and what's Beijing's real game plan? Let's cut through the noise and get to the signal. This move wasn't impulsive, it was surgical. China's Ministry of Commerce quietly updated its rules, labeling all non-essential investments to hostile countries like the U.S. as suspended, effective immediately on March 17, 2025. China's foreign exchange regulator doubled down, halting all outbound investments to U.S. firms, citing geopolitical risks and asset security. No press conference, no fanfare, just a leaked directive buried in regulatory filings later confirmed by Reuters. The numbers tell the story. Chinese investment in the U.S. has already plummeted over 95% since 2018, from $46 billion to just $2.3 billion per the Rhodium Group. This new freeze drops it to zero. Professor Zad Daojiang from Ping University calls it a calculated move to squeeze U.S. markets without sparking outright retaliation. But here's the kicker. It's not just about what China's blocking, it's where they're redirecting that money. This doesn't feel like a pause. It feels like the opening salvo of a financial siege. China's been quietly untangling itself from U.S. economic dependence for years. In 2024, they dumped $14 billion in U.S. treasuries, the biggest sell-off since 2016, slashing their holdings to $775 billion according to the U.S. Treasury. Meanwhile, Chinese state banks cut off dollar transactions with U.S. banks, citing new compliance rules from the People's Bank of China. U.S. Commerce Secretary Gina Raimondo warned in January 2025 that China's restructuring its financial ties to gut America's leverage. Washington's usual tools, tariffs, export bans, are too slow to keep up. Sanctions have only pushed Beijing closer to allies like Moscow, Riyadh, and even Brussels, where European firms are lobbying to dodge U.S. restrictions. The leverage gap isn't just close. Now let's bring it home. Foreign investment in the U.S. tanked 22% in 2024 per UNCTAD's latest report, and 2025 projections show another 19% drop. Chinese capital was the biggest hole, but others are pulling back too. Norway's sovereign wealth fund dumped $7.1 billion in U.S. tech stocks, blaming regulatory chaos. Japan's massive pension fund slashed its U.S. real estate holdings by 30% after Moody's downgraded regional banks in February. With $4.1 trillion in U.S. corporate debt due by the end of 2026 per S&P Global, and fewer foreign buyers to refinance it, companies are turning to pricier domestic loans. This isn't just a cash crunch, it's a slow strangulation of the financial lifeline, hitting mid-sized firms hardest. And when those companies look for a bailout, the options are grim. With equity drying up and bank loans tightening, U.S. firms issued a record $430 billion in high-yield junk bonds in 2024, a 38% spike from the year before, per Bloomberg. This is the new reality, a financial squeeze that's only just beginning. So what's next and how can you prepare? Stick around as we dive deeper into Beijing's endgame and what it means for you. The U.S. economy is hitting some serious turbulence in 2025, and it's not just about higher prices at the store. Let's break it down. Yields on investments have skyrocketed to 9.6%, up from just 5.2% in 2022. That sounds great for investors, but it's squeezing companies hard. Take Hartwell Tech, a Boston-based manufacturer. They were set for a $180 million equity deal backed by Chinese investors until an investment freeze killed it overnight. Desperate, they turned to Apollo Global for emergency financing at a brutal 11.3% interest rate, putting their intellectual property and real estate on the line. Fitch Ratings now warns that 1 in 5 mid-sized U.S. firms could face serious debt trouble in the next 18 months. Private credit funds are stepping in, but their tough terms are pushing businesses into deals that scream survival, not long-term success. So, what happened to America's plan to bring manufacturing back home? President Trump's 2025 executive order, pumped up tax credits for reshoring to rebuild U.S. supply chains. But the National Association of Manufacturers says 62% of companies planning to expand in the U.S. are struggling to find funding, especially without foreign partners. Big projects like an $8 billion battery plant in Michigan and a $3.1 billion robotics hub in Nevada, both with Chinese or Taiwanese backing, are either delayed or dead. Even Intel's $20 billion Ohio chip factory, meant to be a reshoring win, paused its second phase due to funding snags. Economist Asar Prasad told Bloomberg, "Without diverse capital, these projects risk being more symbolic than game-changing. Localizing supply chains spikes costs, and the reshoring dream is crashing into a harsh reality. There's just not enough money to go around. Consumers are feeling the pinch from Trump's 2025 tariff expansion is becoming more evident. Duties now slap over $500 billion in Chinese goods, up from $370 billion in 2020, with average rates hitting 22%, according to the Peterson Institute. This is driving up prices for electronics, appliances, and auto parts. Appliance costs alone jumped 16.7% year-over-year in the first quarter of 2025, as per the Bureau of Labor Statistics. Retail giants like Walmart and Target are sounding alarms, saying tariffs are eating into their margins. The National Retail Federation estimates that the average household will shell out an extra $1,950 for goods by the end of the year. Companies are in a bind. S&P 500 profit growth tanked to just 1.2% in the fourth quarter of 2024, down from 4.5% the prior quarter, according to the Wall Street Journal. Firms can either absorb these costs or pass them on, but with inflation above 3.6% and wages barely budging, hiking prices risks tanking demand and balance sheets. Yet this might just be the warm-up. Economic uncertainty is at a decade high, outpacing the 2020 lockdowns and the 2008 crisis, according to the Economic Policy Uncertainty Index. Tight monetary policy, erratic fiscal moves, and unpredictable trade sanctions are colliding during a shaky global recovery. The Conference Board's CEO Confidence Index cratered to 37 in March, the lowest since mid-2020, with 68% of executives blaming unclear policies. Bank of America analysts say capital investment is stalling, not from high costs, but from sheer confusion. Investors are bailing, with over $120 billion fleeing the U.S. It's a crisis of trust. Allies are starting to hedge their bets. Germany's BASF doubled down on a $10 billion expansion in China in February 2025, right after Chancellor Merz inked an energy tech deal in Beijing. France's economy minister, Bruno Le Maire, sealed a yuan-denominated LNG deal, sidestepping the dollar. The European Chamber of Commerce in China reports a 19% surge in European investment in Chinese industrial zones in the first quarter of 2025, drawn by Beijing's policy stability. Even Saudi Arabia is shifting $27 billion into a China-Singapore AI fund, moving away from U.S. treasuries. Former IMF chief economist Kenneth Rogoff told the Financial Times, "The U.S. isn't losing allies out of spite. They're diversifying to hedge against American chaos. Beijing's offering predictability, and that's a powerful draw. But here's the kicker. China's investment freeze might be the opening move in a bigger play. It's not just defensive, it could be strategic." While boosting its own market, in March, China's Securities Regulatory Commission fast-tracked foreign IPOs in Shanghai and Shenzhen with 38 new listings in the first quarter, a 52% jump from the prior quarter, according to Quinn Global. China's sovereign wealth fund also poured $19.4 billion into Asian debt markets, per a leaked HSBC report. The digital yuan, now in swift settlement networks across 13 countries, allows deals to bypass the dollar entirely. HSBC's Harold Wong says, "It's not about dethroning the dollar overnight. It's about making it just one option, not the only one. If China convinces even U.S. allies to ditch dollar-based trade, the global financial system could shift, not through sanctions or speeches, but through cold, hard math." What's next? Thanks for watching. If you found this breakdown eye-opening, hit that like button and subscribe for more deep dives into what's shaping our world. Let us know your thoughts in the comments. What do you think this means for America's economic future?